All right. 50-year mortgages. Are they good? Are they bad? Are they inevitable? The Federal Housing Finance Agency in the United States came out recently and said the Trump administration is working on a 50-year mortgage proposal to aid in lowering the barriers of home ownership. Now, the average first home buyer in the United States is now 40 years old. For comparison, New Zealand, we're sitting at around 36. So if you're 36 and you sign up for a 50-year mortgage, you're paying that thing off at the age of 86. It sounds insane. That's over 2 decades after most people think retirement happens. Is it an insane idea then? Well, perhaps it is. But is it coming anyway? And will it come to New Zealand? And to work out and figure out whether a 50-year mortgage is actually viable in New Zealand, we need to first understand how mortgages work a little bit. And it also means that we need to understand a little bit more about New Zealand's New Zealand's housing market. So in this episode, I'm going to walk you through how principal and interest mortgages work, what the rest of the world is doing in terms of their principal and interest mortgages, and whether this madness of 50-year mortgages will actually head our way. Now, if you don't know me, my name is Darcy Ungaro. I'm a qualified financial advisor working with everyday people sorting out their finances who are aiming at the best years of their life yet to come. On this channel, I talk about property and I talk about non-property ways of building wealth in the New Zealand context. If that sounds like a bit of all right for you, then make sure that you hit subscribe. Let's get started. Okay, so here is the thing that catches most people out when they think about mortgages in New Zealand. To do the mortgage thing really well, you need to understand and juggle three different time frames. These time frames or terms are completely independent of each other, and that's an important thing to keep in mind because if you mess this up in the future, you could pay way more to the bank than you need to. The first one is the principal and interest term. This is fairly straightforward. It's basically how long you have committed to paying off the entire mortgage. And in New Zealand, 30 years is the maximum amount of time you can have. So if you take out a $500,000 mortgage on a 30-year loan term, which is effectively how it comes out of the box for most people, the bank expects you to pay that bad boy off within 30 years. That's the deadline. And at the end of those 30 years, you will own the home outright. That's the prize. Now, the second term is the fixed interest rate term. This is where people start getting confused, in my opinion. Your interest rate doesn't have to match your loan term, not even close. You can fix your interest rate for anywhere from 6 months all the way up to 5 years as a maximum. That's it. So you might have a 30-year loan term, but you've only locked in your interest rate for, say, 2 years. Well, after 2 years, the fixed interest rate expires and you have 28 more years left on your principal and interest term. You now have to select another fixed rate term or refix unless you're happy for the rate to convert onto floating, which means it's subject to change at any time. There's a lot of detail on this one. Now remember, while the fixed rate term is counting down, your loan term is counting down separately. The clock doesn't reset, it just keeps on going. Now, the third term is the interest only term. Now, this one is optional and it's most often used by property investors where there's an incentive to pay down tax deductible debt only after non tax deductible debt, such as a mortgage on their own home, first. Now, normally on a principal and interest mortgage, when you make a payment, it contains two components: principal, which is the actual money that you borrowed from the bank in the first place, and the interest cost. That's the bank's charge for lending you that money. Early on in your mortgage, most of your payment is actually interest, little bit of principal. But by the end, most of your payment is actually principal and only a very small of interest. That's how most mortgages work, and it's called amortization. But let's say that you are a property investor and you've been approved for up to 5 years interest only. None of the payment goes towards reducing the amount that you actually owe. So it may sound dumb, but for investors that are managing multiple properties, sometimes it does make sense just to keep those payments as low as possible. Like a fixed rate term, throughout an interest only term, the principal and interest loan term doesn't stop counting down. So that 30-year clock starts from the first day that you draw down the loan, remember? no matter what happens. So if you have 5 years interest only and then you don't have it anymore, or you can't get interest only again, you now only have 25 years left to pay off what you owe. So, just to recap on all of this stuff so far, you've got three independent timelines: the loan term, which is 30 years maximum, the fixed rate term, which can be 6 months all the way up to 5 years, and potentially the interest only term, which is 1 to 5 years but can be extended by a further 5 years. Now, the reason why I'm drilling into this level of detail around mortgages in New Zealand is because that's not how mortgages work in other countries, but specifically the United States. And that difference is going to matter when we talk about whether or not a 50-year mortgage is even possible here. So let's start with the United States of America. In the US, you can lock in a 30-year fixed rate mortgage for the entire 30 years of your loan term. Your payment is actually exactly the same in the first year as it is in year 30. That's it. And it's unique to the US. No other developed country that I know of does this. And how can they do this? Because of two government-backed entities called Fannie Mae and Freddie Mac. And it's basically why the American housing market works so different than everywhere else. Canada, the UK, Australia, and New Zealand, they all allow 30-year principal and interest terms, but you can only lock in your interest rate for a maximum of 5 years. So you end up refixing or even refinancing every 5 years or even sooner, whether you like it or not. It's stressful at times, people can make mistakes, it's annoying, and it's a massive disadvantage compared to the US in terms of managing interest rate risk. Now, recently on Truth Social, President Donald Trump posted this image of himself next to President Roosevelt, implying that he was one of two great presidents because while one invented or launched the 30-year mortgage, the other one was going to launch a 50-year mortgage. Now, I found this interesting, so I did a little bit of research. And before the Great Depression, a typical mortgage principal and interest term was less than 10 years. I think it was around about 5 to 7 years. The 30-year loan term came out of the New Deal right after the Great Depression, and it was a way to incentivize new construction of homes. And eventually, it moved into the mainstream in the 1960s. It became the thing to do. And the crazy thing was, when the 30-year mortgage was first rolled out, the average life expectancy was into the late 50s and early 60s. So almost 90 years ago, people were already taking out mortgages that had a lifespan longer than they did, which I find fascinating considering most of the criticism aimed at the 50-year mortgage is that it will last longer than our working life will last. Well, how about your real life? Now, fast forward to today, and thanks to a much longer life expectancy, paying your mortgage off into your late 80s is still technically an improvement on what it was like 90 years ago. In the US, there's a law called the Dodd-Frank Act. It was passed after the 2008 financial crisis to stop the banking system from imploding again. And one of the rules that it created was called the qualified mortgage rule. It says that mortgages can't exceed 30 years. Simple as that. And it's a hard stop. To offer a 50-year mortgage, then, you actually first need to change that rule, which requires the involvement of Congress. And right now, it's kind of hard to see that actually happening, but who knows? Now, in New Zealand, we sort of kind of have an equivalent law called the CCCFA. This stands for the Credit Contracts and Consumer Finance Act. And I think it was partially responsible for the dramatic drop-off in lending activity that occurred right before the New Zealand property market hit its peak in 2021. It's similar in spirit to the Dodd-Frank in that it's designed to protect borrowers, but the CCCFA doesn't specifically restrict loan terms. So when a bank wants to offer a 30-year fixed rate mortgage, what happens is that the bank needs to hedge their interest rate risk. In other words, if they guarantee your interest rate, they need to make sure that the interest rate they have to pay for that money doesn't increase while yours stays the same. So they need to hedge that risk by buying long-term bonds with matching 30-year durations. In other words, because the bank is buying an asset that moves in the opposite direction when the market interest rates change, they're now protected against the risk that they're taking on the mortgage that they're giving you. Hopefully that makes sense. In a deep wholesale market, like what exists in the United States, there are thousands of buyers and sellers constantly trading bonds. So banks can always find a match and lock in pricing. But in a shallow market like in New Zealand and Australia, and even in Canada as well, and the UK, there aren't enough players or volume. So it's hard to find someone to buy those long term bonds from you. Or if you can find someone, the pricing is just too expensive. So without that ability to offload that interest rate risk via bonds, a New Zealand bank is stuck holding that 30-year interest rate risk themselves. And that's why it's far too risky for them to offer this and to even justify talking about that product. So it's the same old answer. New Zealand is just too small. Our wholesale markets are shallow, and we also don't have those institutions like Fannie Mae and Freddie Mac that can allow the banks to move the risk off their own books and onto someone else's. So while we can't break that 30-year barrier, take heart, because even the Australians can't do it, and no one else can do it apart from the US. But that is just for the short term. And take heart, if you really wanted to, you could eventually pass away and leave your mortgage to your offspring, I bet, because I believe that in the long term, it is inevitable that we will see 50-year mortgages. And here's why. Over the average working life, a house price grows faster than the median wage does. And that's the reality that we have with the financial system that we operate in. And while it would be nice to have a negative interest rate on your mortgage so that the bank actually pays you for borrowing money from them, I don't think that's realistic. Interest rates then do have a floor. There's only so far they can fall. And so it really only leaves one other lever left to make housing more affordable, to stretch out the loan term. Now, the simple calculation that I've done showed that the extra 20 years added onto a 30-year mortgage can reduce your overall payments by 11%. Now, of course, if you're borrowing the money for 20 years, that's going to be way more expensive, and you're paying roughly 2.2 times the actual purchase price of the property if you borrow 100% of the purchase price under that simple example. So it's not ideal going to 50 years, but for those that are struggling with getting into the housing market, this is a real lifeline. Now, the average first time buyer in America is actually 40 years old. The 40-year-old property virgin. That is crazy. Now, it used to be 28 in 1991. In New Zealand, we're at 36. So we're a little bit better, but we are climbing. People are buying later, though, not because they're immature, they're irresponsible, and they prefer living in their parents' basement. They're buying later because they can't afford to save the required deposit. Most people actually don't pay off their mortgage in 30 years anyway. They change banks or they refinance. And when they refinance, they often reset the loan term up to the maximum term allowable anyway. Now, my wife and I did this exact thing here in New Zealand. 8 years into a 30-year mortgage, we refinanced and we reset the loan term up to the maximum amount allowable. That was a 30-year mortgage. Again, so we did that to improve our cash flow. Why? Because we wanted to take out even more mortgage debt to buy even more property. So in a way, a 50-year mortgage just formalizes what's already able to be implemented if you're able to change banks halfway through your mortgage term. It would just be good, though, to be able to fix the interest rate for that exact period of time as well. So you might be thinking, hey, is a 50-year loan term on my mortgage appropriate? Is it good or is it bad? I think the answer can actually be a little bit counterintuitive. As I've alluded to, if you have a longer loan term, you're paying way more in interest, but it's more affordable, which means that more people will be able to get into the housing market to start with. It also can free up your cash flow so that you can start to invest outside of property, which is a really big problem, especially here in New Zealand, where the majority of people look at their property as their primary store of resource. The problem is when they eventually reach retirement age and their income stops, all of their wealth is locked up into an indivisible asset, which basically has to be sold, or you have to take out a mortgage again, a reverse mortgage, to be able to benefit from that wealth. In some cases, longer loan terms can be more strategically sound than most people realize. And here's why. When you borrow money to buy property, you're essentially taking advantage of how the financial system works. Or more specifically, you're taking advantage of a flaw in the financial system. You're shorting the dollar when you borrow. So, in simple terms, shorting means that you're betting that something will go down in value. In this case, if you believe the value of our money that we use here in New Zealand will decrease in value over time through the process of inflation, which I don't think is that hard to believe now, then borrowing it from the bank to buy somewhat scarce assets like property can be an effective wealth building strategy. Inflation will constantly erode the real value of that debt that you borrowed during a period of time in which your income is typically rising. So 50 years isn't really that scary when your income is adjusting for inflation the entire time. And the longer your loan term, the more inflation works in your favor. So if you've got a 50-year mortgage instead of a 30-year mortgage, and you have a strategy to repay it, remember, you're getting more years in terms of inflation eating away at the real value of that debt. Now, you might be wondering, at 86 or however old you are, when you've reached the end of that 50-year loan term, what do you do then? Well, more often than not, what people do when they get older is they sell their property to buy something of lower value. They'll be able to clear that mortgage in one lump sum. Now, I'm not saying everyone should max out on mortgage debt or go crazy with a 50-year mortgage if and when they can get it. That's not the point of this. The point is that for some people, for a lot of people in this environment, actually, a longer loan term might actually be the only way that they can afford a house. Not everyone will choose to exploit a strategy like this, but the fact that you end up paying far more in interest over 50 years versus 30 years misses the point. We can't be too dogmatic about any strategy to build wealth in this world, in my view. So, with all that said, I think we can now answer the question of whether or not New Zealand will see a 50-year mortgage. Now, it's not going to happen in the short term. That's my very easy prediction. That regulatory stuff and the wholesale market depth stuff, those issues are real. But given house prices keep running away from wages, and they must continue to do so for the financial system and the New Zealand economy to keep running, means that it's an inevitability that a 50-year mortgage will be offered formally at some stage. We live longer now than we used to, and will also likely have to work longer. See also New Zealand superannuation. And in a world where house prices continue to double every 7 to 10 years, I suppose in a way, maybe that offsets some of the sting of knowing that you're in debt for half a century. Understandably, though, parts of this don't sound very wise. And in a perfect world, none of us would be in debt into our 80s or into our 60s or at all. As usual, this isn't about what should happen, but what will happen. Because our currency loses value and because we're dealing with a property market which has to keep reaching all-time highs for systemic stability, the only way for that debt to rise is to stretch out the repayment terms. Now, I'm not smart enough to know how it'll work in New Zealand eventually, but I suspect it's going to happen at some stage. That's it for this one, but let me know what you think. Would you take out a 50-year mortgage term if you could have one? If not, why not? Do you think it's a good thing, bad thing, or otherwise? We'll catch you in the next one.